It's not crazy to suggest that one legendary Wall Street investor could be one of the most influential financial minds in America right now. Because when two of the most powerful economic roles, the ones that move interest rates, liquidity, debt issuance, and market psychology, are filled by people trained under the same macro playbook, your retirement, your 401k, your mortgage rate, and your portfolio can all get pulled into one very specific worldview. And here's the part you won't hear clearly in mainstream media. This isn't just smart people getting appointed. This is about concentration of influence. One investing philosophy, one network, one feedback loop. And what happens next could either protect your wealth or wreck it, depending on how you're positioned. By the end of this video, you'll understand why this matters more than politics, what the macro playbook looks like, the two most likely policy paths from here, which parts of the market tend to win in each path, and the portfolio framework that keeps you okay even if you're early, late, or wrong on timing. Quick disclaimer, this is education only, not financial advice. All right, let's break this down. Most people hear Fed and their brain switches off. So let's make this practical. The central bank controls short-term interest rates and liquidity conditions. That influences your mortgage, your credit card rate, your savings account yield, bond prices, stock valuations, and how easy it is for companies to borrow and expand. The Treasury controls fiscal operations and debt management. That influences government spending, taxes directly or indirectly, how much debt gets issued, and the overall pressure on interest rates. Normally, these institutions are supposed to act like a counterbalance. Not perfect, not pure, but at least the idea is they don't become one unified machine. So when leadership in both areas comes from the same macro ecosystem, same mentor network, same philosophy, same reflexes, you don't just get coordination, you get the risk of groupthink. And markets hate one thing more than bad news: uncertainty. If markets believe policy will swing hard, flip fast, or prioritize specific asset outcomes, you'll see it in volatility, sector rotations, bond market moves, and currency strength or weakness. That's why this matters. Now let's talk about the source of the philosophy. In the investing world, there are good investors, and then there are investors whose names make the whole room go quiet. This person is often described as one of the greatest global macro investors of the modern era. And global macro matters because a macro investor isn't obsessed with one company's product. They're obsessed with the system: interest rates, inflation, currencies, credit conditions, government policy, risk appetite. They look at the biggest levers and they place big bets. This investor is widely associated with exceptional long-term results, famous macro trades, and a reputation for spotting regime shifts early: tech bubbles, financial crises, inflation cycles, currency pressure. Even if you don't know the name, you've felt the effects, because macro decisions hit everyone. And here's what makes the story important. This investor isn't just known for making money. They're known for a philosophy that can be boiled down to 3 traits: flexibility, conviction, risk control. Those traits are powerful in markets. But when a similar mindset influences public institutions, it can produce outcomes that are great for some portfolios and brutal for others. So let's unpack the playbook in plain English. First, flexibility. The defining trait is not marrying ideas. If the data changes, they change. No ego, no loyalty to a narrative, no "I said it on TV, so I have to stick with it." That's a massive advantage in trading. But in public policy, flexibility can turn into whiplash if it's too reactive. Second, conviction. When macro investors see a real regime shift, they don't nibble, they size up, they concentrate, they push hard when they believe the odds are stacked. That can create huge performance when they're right. It can also amplify damage when they're wrong. Third, risk control. The religion is survival. Stops, hedges, position sizing, cutting losses, avoiding blowups. That's why the best macro investors are rare. They can be aggressive without dying. Now here's where the story becomes investable for you. If the people running monetary and fiscal policy are deeply shaped by this playbook, the market will try to front-run it, whether the playbook gets executed or not, and markets trade expectations. So what should you model? Two major paths, and the difference between them is everything. Path 1 is what I'll call the inflation credibility path. In this world, the priority is fighting inflation and restoring confidence in monetary discipline. Currency credibility matters more than keeping markets comfortable. What does that look like? Rates stay higher for longer. Liquidity stays tighter. Balance sheets get restrained. Financial conditions are not rescued quickly. And yes, the economy can slow. This path can look responsible, but it's painful because modern asset prices are highly sensitive to liquidity. A lot of markets have been trained to expect support. So if policy leadership signals, no, we're not saving every dip, then you get repricing. What tends to get hurt? Long-duration growth stocks, unprofitable tech, anything trading on dreams rather than cash flow, small caps that rely on expensive borrowing, over-levered businesses, speculative risk assets that require cheap money. What tends to do better? Defensive sectors with stable cash flows, companies with strong balance sheets, businesses that can survive without refinancing every year, cash flow quality. In some cases, value factors, depending on how deep the slowdown goes. And sometimes certain commodity exposure, but be careful, tight policy can also crush demand. In this path, you don't want hype, you want durability. Now path 2. Path 2 is what I'll call the market stability path. In this world, the priority becomes avoiding recession, keeping debt service manageable, stabilizing markets, and maintaining economic momentum. This often means cutting rates sooner, loosening conditions, supporting credit markets, keeping the financial system calm. This can be bullish for stocks in the short to medium term, but it's not a free lunch. Because if rates are cut aggressively while deficits remain large, you can trigger another wave of inflation, or currency weakness, or both. So you can get a situation where your portfolio goes up, but your cost of living also goes up. That's a weird form of winning. You feel rich in your brokerage account, but poorer at the grocery store. What tends to benefit in the market stability path? Growth stocks, high beta tech, small caps, if credit genuinely loosens. Anything long duration where valuations are sensitive to rates. Speculative themes that wake up when liquidity returns. And if easy policy weakens the currency, then you often see support for commodities, hard assets, gold-type hedges. Sometimes international assets depending on currency effects and earnings translation. Now here's the key. You don't need to perfectly choose path 1 or path 2. You need a portfolio structure that doesn't collapse if you're wrong, because the biggest losses happen when you build a portfolio that only survives in one world. So let's talk framework. Most investors lose because they demand certainty. They want one answer. Are rates going up or down? Real life doesn't work like that. So the correct approach is to build a structure that works across outcomes. Here are the rules. Rule 1. Don't make single-point bets. If your entire future depends on one policy outcome, you're not investing, you're gambling. That means avoid portfolios that are basically all growth tech, all cash, all one commodity, all one theme, all one sector. Diversification isn't about being fancy. It's about surviving being wrong. Rule 2. Own assets with pricing power. Pricing power matters in both paths. If inflation stays sticky, pricing power protects margins. If growth slows, pricing power protects revenue stability. Look for businesses that can raise prices without losing customers. Strong brands, essential services, high switching costs, mission-critical platforms. Companies with real profit and real cash flow. Rule 3. Balance growth exposure with defense. Instead of trying to time every meeting and every headline, use balance. It can look like a barbell. One side, quality growth that can run if rates fall. Other side, defensive cash flow stability if conditions tighten. Rule 4. Keep liquidity so you don't get forced out. People don't lose because they're wrong on the big picture. They lose because they run out of cash during volatility and get forced to sell at the bottom. So keep an emergency buffer, not because cash wins long term, because cash keeps you alive. Rule 5. Risk management is not optional. This is the real edge the pros have. They don't just pick right, they cut wrong quickly. You need rules like, how big can one position be? How much can it drop before you exit? What would make you change your mind? Hope is not a plan. Now let's map this back to the market in a practical way. If policy leadership leans toward tight conditions and inflation credibility, here's the mindset. Prefer profitability over promises. Prefer strong balance sheets over leverage. Prefer stability over hype. This is where you see relative strength in defensive areas and quality factors. If policy leadership leans toward easier money and market support, the mindset shifts. You can take more growth exposure. You can benefit from rate sensitivity. You can look at themes that wake up when liquidity returns. But you still need risk controls because the easy money path can also reignite inflation, which can force a sudden pivot back to tightening. And that's the hidden danger here: whiplash. Because if leadership is highly data reactive, you can get fast narrative shifts. Cut rates, then fight inflation, then cut again, then tighten because the bond market revolts. And the more violent the pivots, the more violent the sector rotations. So what should you watch? Not the headlines, not the speeches as stories. Watch the actual levers. Watch how leadership reacts to inflation prints. The reaction matters more than the number. If inflation comes in hot, do they tolerate it or do they slam the brakes? Watch the labor market trend. If employment weakens, do they pivot quickly to stimulus or do they hold discipline? Watch the bond market. If yields spike or the curve behaves badly, policy can be forced into action. Bond stress can create sudden pivots. Watch overall liquidity conditions. Are credit spreads tightening or widening? Is borrowing getting easier or harder? Watch the currency. A stronger currency can tighten global liquidity. A weaker currency can support commodities and international earnings, but may worsen inflation pressures. You don't need to be a macro genius. You need to consistently watch a small set of signals and stay flexible. Now, what does this mean for a normal investor holding index funds and a retirement account? It means your portfolio is not just exposed to companies, it's exposed to rates. When rates fall, certain parts of the market can explode upward. When rates rise or liquidity tightens, those same parts can collapse. So if your portfolio is concentrated in long-duration growth without protection, you're basically making a bet that policy will always support it. Sometimes that bet works. Sometimes it destroys you. The smarter approach is to structure your exposure so you can participate in upside, but you can survive a shift. That's the whole game. Now let's talk about the biggest retail trap: ego. Retail investors buy a story, then marry the story. The stock drops, and instead of cutting, they say, "I believe in it," or "I'll wait until it comes back." That's not investing. That's emotional attachment. The macro approach is colder. If the data shifts, you shift. If the trend breaks, you cut. If you're wrong, you exit fast. You don't need to trade every day. You need rules that remove ego from decisions, because ego is expensive. Now, do we know the exact policy path over the next 6 to 12 months? No. But we can be honest about one thing. This will probably not be smooth. Because leadership faces constraints no matter what they believe. Massive debt refinancing needs. political pressure for growth, inflation sensitivity, bond market reaction, global capital flows. That means volatility is likely. And volatility creates opportunity, if you're prepared. Prepared means not all in, not all out, not married to one narrative, not using hope as your strategy. So here's the clean takeaway. This isn't about one person controls everything. It's about something more realistic and more investable. A powerful macro philosophy may have unusually high influence at the exact moment markets are most sensitive to rates, inflation, and debt dynamics. That means policy shifts could come faster, market rotations could be sharper, and the winners could change quickly. So your job isn't to guess the next headline. Your job is to build a portfolio that survives either regime and manage risk like a professional. Size properly. Cut losses. Keep liquidity. Stay flexible. Because flexibility without risk control is chaos. And risk control without flexibility is denial. You need both. If this helped you see the game more clearly, share it with someone who still thinks the market is only about earnings and product launches. Because in regimes like this, macro policy can overpower everything. And the people who understand that early don't just protect their wealth, they position ahead of the crowd.